So let's get started talking about chart patterns. And tonight we're going to be talking predominantly about triangles. Now, chart patterns are well documented in technical analysis literature and are based on the psychological phenomena that occur between buyers and sellers of financial instruments in liquid markets. Pattern formation do not form a trading system, but rather provide an indication of future trends of an asset's price as the price breaks key psychological barriers in the form of support and resistance lines. Now, that's a lot of words. Okay. So, I am sure you have heard about chart patterns for online trading and their relation to technical analysis. You probably know about double and triple tops, head and shoulders, and rectangles. So, in order to have a complete understanding of chart pattern trading, we should also gain a good understanding of one of the most common on chart formations. What I'm referring to are triangle trading patterns. So, in this webinar, we will discuss the basic triangle formations and some ways to properly identify and trade these patterns. So, let's go over to some live charts, and I'm going to show you what all or the most popular chart patterns look like. Hold on, let me pop up some live charts here for you. And here we can see what I've put together, which we call market structure. These are a set of all the basic patterns you'll ever see appear in your chart. You can start from the left and see a double bottom. We'll see a bull flag. We'll see a bull pennant. We'll see an ascending triangle, a descending triangle, triple tops, bear flags, bear pennants, inverted head and shoulders, inverted cup and handle, expanding wedge, cup and handle, and head and shoulders. Okay. Now, you could cut these in half because you notice there's an inverted head and shoulders and a head and shoulders. One comes off an uptrend, the other comes off of a downtrend. The same thing we have in bearish and bullish pennants and bearish and bullish flags. We also have ascending wedges and descending wedges. So you can notice here, let me just circle it for you. This is an ascending wedge because an ascending wedge will form during an uptrend. A descending wedge forms in the middle of a downtrend. Here you have a bear flag, and here we have a bull flag. So there's one for each opposite direction of the markets. But these are primarily all of the most studied, well-used pattern. There's all kinds of weird stuff people come out. There's eclipses and everything else. But these are the ones that the market has tested for years and that we all know about. Okay? Lots of times you'll read about flags and pennants, and they're good to know. Okay. But triangles are the most well used, well documented of all of these patterns. And a triangle is a formation on your chart. Let me just get my markings up here. Is a formation on your chart. Now we have descending triangles, and symmetrical triangles. I personally don't differentiate between any of the three. Okay. A descending triangle forms when you have a upper support line that is running on an angle and a resistance line and a support line that is horizontal. A descending triangle usually forms in a downtrend. The reverse is an ascending triangle where the top line is horizontal and the the bottom line is angular. And then a symmetrical triangle occurs when both of these support and resistance lines are coming in on a similar angle to each other. So you have symmetrical, descending, and ascending. But they're all three triangles. I don't try to separate them because there are no definitive rules about the type of triangle. Because a triangle does not give us a directional clue. A triangle tells us something is happening in the marketplace. Okay. And we don't know what's happening is price is getting pushed into the apex of a triangle where we know sooner or later it has to break out. Okay. And that's why we use the word break out because it can break upward or in this case, it broke down. Okay. But once it breaks out, there are certain rules that we can apply to a triangle to determine its momentum and how far it will travel upward. And you do this by measuring this back of the triangle. And we can judge the momentum of a breakout because it will be equal to the same move here. Because we need to be able to set our target point so that we can apply risk management. Okay. We can also use a triangle to determine stop loss and entry and exit points. So this is what we would use a triangle for because a triangle doesn't give you directional clues. Now, there are some people that say certain things happen in a triangle, or a descending triangle only happens in an uptrend and is predicting a downtrend or it's predicting that a uptrend will continue. The problem is it's 50% right and 50% wrong. Okay. And I'll show you statistically because we tested about 700 different triangles to see if any of the rules, if you could apply any general set of rules to a directional breakout. But let's go back to the PowerPoint. Now you see what a triangle looks like and you see what the patterns look like. Let's talk a little bit more about why you need to know these things. Okay, a triangle pattern is a specific figure formed on a price chart, typically identified when the tops and the bottoms of price action are moving towards each other like the sides of a triangle. When the upper and the lower level of the triangle interact, traders expect an eventual breakout from that triangle. As such, many breakout traders use triangle formations to identify breakout entry points. So there are, and as I mentioned, there are different kinds of triangles that can be seen on a price chart. And the three are ascending, descending, and symmetrical. So what we're looking at on here is a symmetrical chart pattern. Why do we know it's symmetrical? Okay, it's when the support and the resistance line, the upper line and the lower line, are both on angles converging to each other. An ascending and descending triangle would have one that is flat while the other is on an angle. So a symmetrical triangle is a situation on the chart where the tops of the price action are lower and the bottoms are also higher. Also, the two sides of the triangle are inclined with the same angle. This creates a symmetrical character of the triangle. Typically, with a symmetrical triangle pattern, the expected directional breakout is unknown. And I'm going to keep harping on that. Unknown. The breakout is unknown. The reason for this is that the bullish and bearish move have equal strength as seen through the price action. When a breakout eventually occurs, it is likely to provoke a price move equal to the size of the pattern. The size of the pattern is the width of that triangle from the beginning of the formation of the triangle. Therefore, you can carefully identify a potential breakout in the upper or lower level of the symmetrical triangle in order to take the right position. So once the market has broken out of the triangle, that's either this way or this way, we can then take this width and drop it onto that breakout. Now, you'll find that statistically and historically, this is quite accurate. It's not my rule. I'm not teaching you something I made up. This is a known, accepted fact within the financial markets. Okay, so like I said, I'm not making this up. It is usually equal to. Now, you have to verify that you have a good breakout before you can just assume that it's going to have the momentum to carry it that direction. So as you see from the example, the potential target is based on the size of the triangle formation. With this type of measured move analysis, you will know what to expect from a symmetrical triangle breakout, whether it breaks upward or downward. Then we have ascending and descending. And you see, the only difference is, and I can't say 100% of the time, but 99% of the time, an ascending triangle forms during an uptrend, and a descending triangle forms during the downtrend. And you can see they're the exact mirror images of each other. So these types of triangles have one flat horizontal side and one sloping side, which is moving towards the flat horizontal side. The ascending and descending triangles are mirror images of each other. They are identified as ascending or descending depending on which side is the flat horizontal side and which has the slope on it. But like I said, I don't pay any attention to the name of them because the rules apply the same: ascending, descending, and symmetrical. There, like I said, there are certain traders, and we'll touch on it, that say when you get a symmetrical and a ascending triangle in an uptrend, the breakout will have more potential for the trade continuation. But like I said, we tested it, and we'll come back to those values towards the end of the class. So this triangle pattern has an upper side that's flat and a lower side that's ascending. In this manner, the tops of the triangles are on the same level and the bottoms are increasing. This type of triangle has a bullish character. Okay. The reason we say bullish character is it appears during an uptrend. When you spot this triangle on the chart, you should be prepared to catch a bullish price move equal to at least the size of this triangle. In this manner, breakouts through the upper level are used for setting entry points for long positions. So on here, the black lines indicate the price action within the triangle. That's just the price chart. The blue lines refer to the sides of the triangle: horizontal, sloping. And the red lines correspond to the size of the triangle at its potential target, which is typically 1-to-1 of a measured move. So we have here and we have here. But it can break out just as easily this way, and you would then apply this here. But some traders say it's got a bullish character. So they're predicting a bullish move, where the reverse is true of a descending triangle in the opposite direction. So such a descending triangle has the opposite characteristics. The flat side of the descending triangle is below the price action, and the upper side on the triangle is inclined downwards. In a bearish market, the descending triangle has a bearish potential equal to at least the size of the pattern. It's very important to mention that the ascending and descending triangles sometimes break through the incline level, causing false signals or trapping some traders along the way. The same holds true of horizontal price zones. You should always try to wait for the close of the candle to confirm the breakout. This will help you avoid many false signals. So in other words, when we get the break, because a lot of times you'll be prepared for it to break here, but it'll break out and go right back in the next candle. So what we want to do is wait for, my rule of thumb is I will decide my trade on the third candle. So I'm waiting for the breakout candle. I'm waiting for another candle. And if the third candle remains in that direction, I won't wait for the close of the third candle. I will then set my trade up, because you don't want to get these false signals, because it can go right back into that pattern and break out upward. Let's go look at a chart, a live chart again. So here, for instance, okay, at some point we were expecting a bullish breakout. you can see the price actually broke above, right, just the wick, but it broke above the breakout, above the resistance line, but it came right back in and then came out. So my rule of thumb is this would be the breakout candle, this would be the confirmation candle, and then this would be the trading candle. So on here, we had a triangle formation. Now we had a descending triangle formation, but where we got? We got the breakout upward. So we would have predicted this breakout to come to here, which would have been our target area, but we didn't quite make it there. We only made it there, but we still would have gotten a solid trade, a breakout candle, second confirmation candle, trade point. And we could have stayed in this trade to that distance. But our original prediction would have been down. So one of the reasons we wait for this third candle is to make sure we're not making a mistake. I would rather get in a trade late and get it in and make money than make too many trades that are unsuccessful. So you need some type of confirmation. The other type of confirmation you would look at is your support and resistance levels, and of course, volume. Now, pennants on charts. And remember when I showed you the market structure? We had bullish and bearish pennants. Bullish and bearish pennants tend to be, are just, to me, are just triangles. And they typically appear during trends and have a trend continuation character. So when you get a pennant, they tend to tell you that the breakout should be in the same direction as the current trend. But again, they're only characteristics. Bullish pennant is similar to a symmetrical triangle in appearance, but the bullish pennant formation comes after a price increase. Now, there are some rules that you might read out there that say you can set two target levels. I never use more than the one-on-one for the width of the triangle. But you could set a one-on-one on the previous leg or a 0.618 of that leg. When the train seems strong and has a steep slope, a one-to-one measure would be a better move. But some people use 0.618 of the leg, okay, and they make a second target. I don't. I've never seen it statistically pay out. So you have the symmetrical triangle. You could have something that's defined as a rising wedge. A rising wedge to me is just another triangle. And a rising wedge is simply when the slope of the upper and the lower, the support and resistance line, are not equidistant and one isn't flat while one is moving into it, and the two aren't symmetrical because they're moving in the same angle. So you have a rising wedge, and a wedge is simply the two support and resistance moving at different, slightly different angles. So here we start out with a symmetrical triangle, then we go into a rising wedge, then we have another symmetrical triangle, then we have a bearish pennant, and then we have an expanding triangle, which I don't keep in my toolbox. Um, because I don't find it as a triangle because I don't find where traders being forced in apex. Here you just have two broadening sloping lines. And on the whole, most traders don't even mention it. But you should be aware of it if you want to be well versed on triangles. So what exactly again is a symmetrical triangle? A pattern is identified by two discrete trend lines. The first trend line connects a series of lower peaks, while the second trend line connects a series of higher peaks. Symmetrical triangles generally form during consolidation, and the volatility tends to decline as the pattern progresses. Okay. Why? You have wider volatility to form the back of the triangle. And as price gets tighter and tighter in the move, it is having less volatility because it's moving less and less. Symmetrical triangles tend to be neutral and can signal either a bullish or a bearish situation. Therefore, a breakout from the pattern in either direction would probably signal a new trend. Okay, now, we can use that symmetrical triangle to set our buy entry point and also to set our stop loss level. So you can get all this from your symmetrical triangle. So since bias upon the conclusion of a pattern pointed higher, we can look for an opportunity to buy. But that's a bias, okay? Because until we get a breakout, we don't know. Once a triangle is identified on the chart, traders will wait for a breakout either above the resistance line or below the support. After a breakout is confirmed with either a closed candle above resistance or below support, a stop can be placed approximately 10 pips below the last swing low of the triangle. A limit equal to the height of the triangle is then placed. So what we have is we take the swing low, which is the lowest point it was in that triangle, and go down 10 pips to set where we would hypothetically put our stop loss. We could set our limit order based on the width of the triangle because we need these two places to calculate our own risk management. Because this is where we should set it, but our risk management may not allow us to set it that far because we can't afford to take that size of a loss in a move. But you have to have something to start. So you have your take profit point and your stop loss point, and then you apply your own risk management. We have the breakout here. This is our confirmation candle, our second candle, and our third candle is our entry point. So the next type on symmetrical, you'll find is just the same thing. It's easy to recognize by a descending trend line intersecting with a flat resistance line. It's often regarded by traders as a bullish pattern characteristics by a breakout above resistance when completed. However, in an ascending triangle pattern, breakouts can take place below resistance. This can especially be the case when the prior trend of a triangle was down. Typically, you want to buy after the pattern breaks resistance, as it did at E here. Now, remember, we might get a breakout down, but we never want to trade against the trend. So when it breaks in the opposite direction of the trend, we may say to ourselves, well, we're trading counter trend at this point. Maybe we don't even, no matter what the clues are, we might not want to trade it. But here in ascending triangle, when we get the breakout above, one candle, two candles, three candles, we would enter our buy. We would use the swing low, go down 10 pips and set our stop loss. Okay. And now we can set our take profit point, which would be that distance. A descending triangle, again, it's the exact mirror image. We would flip it over and do the exact same thing. So A is the beginning of the downtrend, but we can't draw our horizontal line till we get to B because we have no qualification. So to measure the width of the triangle would only be here. We would set our entry point. Let's see, this I would not enter this trade because here we get the breakout candle, but we didn't have here at this point, we don't have the second and third candle on our chart. Okay. So you would consider this for your entry point, but you have to wait for that third candle for confirmation. Our stop loss would be 10 points above our last swing high. Okay. And When we got our confirmed breakout, we would then look for that for our profit level and then set our own risk management tools to determine whether we can make that trade. So now we want to watch it to progress because we've said everything, but we don't have our confirmation. So we wouldn't be entering a trade at that point. Now we see the candle, the chart has progressed. Okay. We have the breakout, we have the confirmation candle, and here's where we would enter the trade on that third candle. Okay. And we would have had a very nice successful run of that price. Actually, the pair descended roughly 90 pips before its consolidation. Now, as I mentioned, the question is how reliable are triangles? So to get an idea of this pattern's reliability, I've analyzed the charts of 5 currency pairs over a 10-year period. Okay, we've taken a 4-hour chart and taken a look at 165 symmetrical triangles, and I measured the trend using the slope of the simple moving average. If the breakout after the triangle was up and the trend was up, this was classified as a correct bullish signal. When the breakout was down and the trend was down, this was classified as a correct bearish signal. Patterns where there wasn't a clear trend were ignored. So what you can see is on the US Canadian dollar, we got a correct breakout, a bearish breakout on a descending triangle, 61%, 5% of the time. But on the Japanese yen, it only was correct 33%. The pound was 52%. Okay. The euro dollar was 61%. The euro Swiss franc was 61%. But correct bullish, that's when we had a ascending triangle and we were projecting it to break out upward, only happened 57%, 40, 57. It's not a big enough success rate that I'm going to jump in there and blindly trade without the third confirmation, that third candle confirmation. Okay. So the odds are about 54% you're going to be right. Now, if you're trading only the odds, that can help you, but you have to also be trading your risk management. Okay, but that's in a 4-hour triangle. If we were to move it back to a slightly to 1-hour 1-hour chart pattern, which is what we should be using for basically our type of trading, look at that. 49%, 59, 50%, 56, 50, 49, 51, 7 average. So you only have a slight edge up if you were trading all of those chart patterns just on the fact that it had a bullish characteristic or bearish and trading in that direction. Okay. And when it was bullish, you only had a 52.9% chance of being correct. But if you moved it to the third candle, you had much closer to a 70% chance of being correct, even though you might lose some price movements or you might not be able to get some of the trades in. Your trades were a lot less risky. So in the test, there was a total of 525 patterns in all charts over the period investigated. The pattern was correct in predicting a continuation in 52% of the cases. Again, bullish patterns had slightly better odds of being correct. Now, sure, if you're a hedge fund with billions of dollars and you can float this out and you're just playing for the, trading for the odds to, statistically to be in your favor, so you had more winning trades, then it's fine, but we can't afford that. So even though the numbers are quite small, this does give some objective data on reliability of symmetrical triangles across forex pairs. When the pattern ends, the volatility dips to a minimum. Support and resistance lines will be very close. The market will then usually start to show some preferred direction. There is no guarantee of this. However, as always, it's best to be prepared for false breakouts and retests of the support and resistance lines. The easiest way to trade this chart pattern is to treat it as a continuation breakout. Here, just wait for a clear break above the resistance in a bullish trend and wait for a clear break below support in a bearish trend. Because remember, if we keep the rule of thumb, only bullish trades in an uptrend, bearish trades in a downtrend, which is the old adage, the trend is your friend, only wait for those to appear and only trade those minimal. So when you have the breakout down in an uptrend, you just don't make the trade. So to do this, we use our support and resistance indicators together with the triangle chart tool. Using the same settings, you can have an indicator draw support and resistance levels that extend from the pattern. The tool can also alert on a break in either support or direction. Okay. Volume is your key tool here, and also support and resistance lines that you've already drawn on your chart from either pivot points, Fibonacci levels, or eyeballing support and resistance, because that will also help you determine how far your break is. Because if you're breaking out, you're breaking right up to a major resistance line. Okay. You got to be a little bit careful where that resistance line is. Or is the breakout right at a resistance line? And did you break not only the triangle, but you also broke a major resistance line? So while there are instances when symmetrical triangles mark important trend reversals, they more often mark continuations of the current trend. Regardless of the nature of patterns, continuation or reversals, the direction of the next major move can only be determined after a valid breakout. So to increase our success rate, we want to look at the trend. In order to qualify as a continuation pattern, an established trend should exist. The symmetrical triangle marks a consolidation period before continuing after the breakout. So at least 2 points are required to form a trend line, and two trend lines are required to form a symmetrical triangle. Therefore, a minimum of 4 points are required to begin considering the formation of a triangle. The second high should be lower than the first, and the upper line should slope down, or the second low. You know, it's okay. Like I said, it's the reverse of the reverse of the reverse. Remember, there's always mirror images. Then we always want to look at volume. As the symmetrical triangle extends and the trading range contracts, volume should start to diminish. This refers to a quiet before the storm or the tightening consolidation before the breakout. Now, duration. Okay. For our type of trading, we want to see a triangle that's had a duration of some time, not something that's just been formed over the last, if you're looking at a 10-minute chart, you don't want to look at some triangle that's just formed over the last, you know, 6 or 7 candles, because you're only talking about a 60-minute period. So you want to look at triangles in a broader time frame. So for our type of trading, we should be looking at finding triangles in 4-hour and 1-hour charts. Now the thing is the breakout time frame. And like I said, my rule of thumb is 1-hour chart, 3 candles out. But you need something in a shorter time frame to give you the exact entry point, because you're waiting for that third 1-hour candle to form, and we're trading in short-term trades. You have to be kind of careful. But after a breakout up or down, the apex can turn into future support and resistance. The price sometimes returns to the apex or the support and resistance levels around the breakout before resuming in the direction of the breakout. Now, price target. There are two methods to estimate the extent of the move after the breakout. First, the widest distance of the triangle can be measured and applied to the breakout point. Second, a trend line can be drawn parallel to the pattern's trend line that slopes up or down in the direction of the break, and the extension of the line will mark the potential breakout target. So, to sum it up, triangle patterns are easy to spot and provide good risk reward opportunities. Traders can quickly know that a big move may be near, as well as a profitable objective and the amount to be put at risk. And there you can then apply your own risk management. Now that you have the knowledge of 3 powerful price patterns, you can step closer to becoming a more confident trader. So that's it for us tonight on triangles, chart patterns. We've looked at ascending, descending, symmetrical triangles. We've added in wedges, we've added in pennants, we've added in flags. And that's a very broad range. I trade predominantly from chart patterns. I don't use many indicators in my trading. I use chart pattern support resistance trend lines. Okay. Because to me, ultimately, price action is the most important indicator. But remember, just don't jump in on the breakout. You can form, whether you want to wait to the beginning of the third candle, the end of the third candle, you can decide and make it your own decision. You could decide at the close of the second candle. You have to make those decisions and test it to see how it works for you. So thank you very much for being part of ETX, and we'll talk to you on Tuesday. Have a great trading week. Good night now.